And what's happened is the baton of liquidity creation has been passed from the central bank to the banking system. And the banking system is doing this because they're buying up the treasuries that the treasury is issuing, the short-dated debt, because that's what they like. But as they buy it up, their balance sheet expands, and that's basically a liquidity and a money supply expansion. And the thing, the crazy thing is here that if you go back to the 1970s, which I can just dimly remember, even me dimly remember, but what you had in the 1970s, there was a similar episode where bank balance sheets started to expand, and that was the source of monetary inflation, and it didn't end well. This is the warning. But what you wanted through that period, the lesson was that you wanted monetary inflation hedges. Gold did well.
Hey everyone, and welcome to another episode of the What the Finance podcast. Today I have the pleasure of working on a very popular guest, Michael Howell. So Michael's the founder and managing director of CrossBorder Capital. So Michael, thanks so much for coming back on the podcast.
Great pleasure, Andy. Good to be here.
Yeah, looking forward to. I think everyone's always hanging on their on the edge of their seats, trying to understand, what's happening in liquidity markets, and you're definitely or liquidity, global liquidity, and you're the man to to talk to about that. So really interested to hearing, very broad overview of what you're currently seeing and what you're watching.
Okay, well, it's we, as you know, we look at global liquidity. That's really the main focus of our research. That was something that we began actually decades ago, right back at the end of the 80s when I was at Salomon Brothers, and that was really when world financial markets were beginning to open up, and global liquidity was really the main driver. And it's sort of come back certainly into fashion in the last 5 to 10 years, particularly with in the wake of the GFC and COVID and whatever. And now, in many cases, market movements are all about global liquidity, particularly if you look at Bitcoin. So it's clearly a major issue to look at. I mean, basically, what we're seeing right now is actually reasonably good liquidity conditions in the world. I mean, that's fair enough. That comes through from partly technical reasons. The Federal Reserve in the US has had to address the debt ceiling, and as a result of that, the Treasury General Account, which is maybe sounding a slightly wonkish concept, but that's the bank balance that the US Treasury holds at the Fed, has been forced to run down to basically pay for US government spending in lieu of issuing lots of debt through this period, this interregnum. And as a result of that, a lot of money has flowed into financial markets. So technically, there's a great deal of cash, certainly in dollar markets right now. That may actually explain why the dollar's been soft on top. I think that's a thought worth holding. On top of that, we've also got a more structural factor, which is, I would say, generally more positive. And that is what China is doing. China's definitely adding a lot of liquidity to markets right now. They've changed direction of policy very clearly. And they began to do that really late in 2024, but that's really carried through this year. So there's a lot of liquidity being issued by China. And you can see that very much, I think, in what's happening to the gold market. The fact that the yuan gold price has rocketed is, I think, pretty much testimony to the fact that the Chinese want to devalue the yuan, certainly as a paper unit against real assets. And they're doing that through injecting lots of liquidity. The question mark I think one's got to have is what the Federal Reserve is planning to do in the second half of the year. And the reason that we're sort of pondering this and maybe slightly concerned is a lot of the rhetoric that's coming out of the Federal Reserve is all about still balance sheet shrinkage. They want to get reserves down, so they say. That's reserves of the banking system. And if you look at their plans are that the balance sheet will continue to shrink through end 2025. And that means actually reducing bank reserves quite noticeably if they're going to hit those goals. Now, I think it's fanciful for them to do that. I think it would be crazy, in fact, if they did take a lot of liquidity out, because it would basically end this bull market pretty abruptly. And I think that's basically the big concern. Now, what I want to do is to add a thought to that, and that is that maybe we're looking at the wrong vehicle when we're looking at the Federal Reserve. And maybe the Federal Reserve is actually deliberately wanting to pare down its balance sheet, because what it realizes is going on the other side is a lot of liquidity creation or proxy liquidity creation by the US Treasury. And that is coming really as a result of two things. One is that we know that the US deficit is blowing out. and it's becoming more and more difficult to fund. And secondly, it's becoming particularly difficult to fund in a world where yields on long-dated coupon debt, in other words, government debt, are actually rising. And although I know the rhetoric that's come out of a lot of the media is that the US is finished, and the US extraordinary privilege or extraordinary the exceptional performance of the US is now over, well behind us, and people want to sort of hit on the dollar and hit on the treasury market. That's actually a fake narrative. If you look at the data, it's not that US yields are driving world yields up. It's actually that world government bond yields are driving US yields up. And that's really the paradox here. The US hasn't lost any of its safe haven status, as far as we can see looking at the data. What you're seeing is actually very clear rises in Japanese government bonds, JGBs. Yields are starting to soar there. And also in Europe, you've seen noticeable increases both in UK gilt yields and in German bund yields. The German bund yields have been going up really because the debt brake has been taken off back in March in Germany to afford a lot of this defense spending, which is likely to be an extra burden on European governments. So that's really the overview picture. Are we bullish? We're certainly bullish near term. I think there's money going into markets and there's a lot of liquidity around. As I say, I raise a question mark about dynamics through the rest of the year. But the question is does the Treasury undertake what may be called a sort of secretive easing through the bill market to try and get try and afford some of this debt? And the problem they've got is with yields rising globally, they're being forced into the short end of the market, and that's effectively proxy liquidity creation.
Yeah, a lot to unpack there. And if I look at when we spoke, sort of, I think it was at the start of the year, you were talking about how you're concerned that there was potentially a hiccup in liquidity. There might have been it was decreasing, and it sounds like the Fed's actions are sort of the main thing that's sort of improved that, I guess, recently. Would you agree with that?
Yeah, I think that what you've seen is a technical move from the Fed. I mean, the fact is the debt ceiling. This is all to do with the debt ceiling, and the fact is because the U.S. government hasn't been able to issue debt, they've had to run down their balance sheet. Now, part of the concern we've got in the second half of the year about what the Federal Reserve does is an implicit assumption, which is actually taken from their stated policy, that they want to get the Treasury General Account rebuilt in the second half of the year. Now, given the fact that the Treasury General Account is now circa 450 billion, and their assumption is they want it back to about 850, that would be about 400 billion effectively taken out of markets if they do that, which is clearly a sizable sum. I mean, that would get US bank reserves below $3 trillion again if that was the case, or that alone happened. So these are sizable amounts, and that's really the uncertainty that we can't be sure about. But on the other side of the ledger, so to speak, or the other side of Washington, what you've got is the government, the Treasury, is basically undertaking funding, or will be undertaking funding now that the debt ceiling is more or less resolved, I suppose. They're going to be undertaking funding much more at the short end of the market. And even though Scott Bessent, through some virtue signaling, was actually suggesting that his Treasury would be, let's say, more open to coupon debt issuance, in other words, longer dated duration issues, because he sort of scolded Janet Yellen for cheating, so to speak, with a lot of short-term debt issuance through bills and very short-dated coupons. It looks like he's going down the same path. He's being forced to follow that. So, that actually is a sort of backdoor way of injecting liquidity into markets.
Yeah, okay. Really interesting to hear. And then you're saying, obviously, you mentioned the global yields are increasing, especially at long dated bonds. Is there anything driving that? You've mentioned, I guess, Germany, you've mentioned UK, you've mentioned the fiscal issues in Japan as well. Are those the main drivers, or are there sort of more a global trend that we're seeing?
Well, it's definitely a global trend. That's right. I mean, sort of parche Chinese yields are not going up for somewhat different reasons. But if you look at the developed world, the major bond markets, so the JGB market in Japan, you look at the bund market, the OAT market in France, the UK gilt market, US Treasury market, yields, or more specifically term premium, are rising right across those markets. Now, it might be helpful to look at some detail of that, look at some charts. So let me try and put up some charts, and then I can sort of walk you through those particular issues. So if you look at the chart that I've just put up here, what this is showing is the yield on the 10-year US Treasury market, which is the orange line at the top. Now, what you can see there is broadly what looks like a flatlining of yields. The dotted or broken line, the orange broken line that runs through that series, is a 200-day moving average. Now, the curious thing about recent data is, despite the very widespread views that the US economy was about to hit recession during the tariff turmoil, if that's the right way to describe it, actually the yield pretty much held up above its 200-day moving average. And that's, I think, was a very, very odd development. And it so happens that maybe the bond market has been correct not to fall through the 200-day moving average, but notwithstanding, the fact is that yields remain elevated. If you dissect what is actually going on in the bond market, bonds really have two components. One is interest rate expectations. In other words, what the Federal Reserve is planning to do with policy rates over the lifetime of the bond, here 10 years. And the other element is a more wonkish concept, which is called term premia. Now, term premia are really critical to understand, largely because we're in a new world, and I would say this is a new world which is dominated by capital flows and liquidity, where term premia really matter. If you look at the data since 2010, something like 90% of all variation in US government bonds, to take one example, have come through term premia changes, not through policy rate expectation changes. And this is a dramatic change. If you look through history, it's normally about 50-50. So there's been a real skew to say term premia are important. Now, what are term premia really representing here? They're pretty much representing the excess supply or excess demand for coupon bonds. And what you're seeing in the black line on the chart, which is looking at term premia, is there is a secular increase in the trend of term premia upwards. So you're seeing these term premia in the US continually going up. This is probably a testimony to the fact that issuance is likely to expand. And because of that prospective increase in issuance, investors want some protection or yield cushion against that. In other words, the excess supply of bonds is going to increase, and therefore yields will have to increase. In other words, prices fall to clear the market. And that's pretty much what that's saying. Now, before we get hung up on the US to say this is, the end of dollar supremacy or the end of the US Treasury market as a safe haven, which is what the media love, of course, to say, that really is, complete bullshit, if I can say that. The fact is that if you look at this following chart, this is looking at daily term premia from the beginning of this year. And what we've done is we've singled out the US in red here, and we've plotted it alongside what's happening in Japan in black, in the French oat market, which is the dotted orange line, and in the German Bund market, which is the solid orange line. Now, what this data pretty much confirm is actually it looks as if the US may be the cleanest shirt in the laundry here, because you've seen an increase in US term premia since January 1, but actually the increase net is about 10 basis points. What you've seen is something nearer 40 basis points going on in the Bund market. You've seen 25-ish basis points increase in French oats and in JGBs, and that really is the problem. So what you're seeing is the US is no longer necessarily a price maker in global bond markets. In this instance, is actually a price taker, and yields in the US are being forced up because of what's happening elsewhere. Now, we can see this in the following chart very clearly, and this is the change in the policy regime that you've been witnessing in Japan. Now, the Japanese bond market is unusual because yields have been so low. And if you look at the chart, what I've drawn on that chart is the actual yield on the 10-year JGB bond in the solid orange line. You can see that actually went negative in 2016 and then again in 2019. So you had negative yields on the JGB bond. The two shaded areas are looking, first of all, at the QQE period of support, which was called qualitative and quantitative easing by the BOJ. And then the other policy that they enacted, which occurred from 2017, which was yield curve control, explicitly trying to keep the yield on the JGB down. Now, as that policy has ended, so you've seen the fair value on the JGB start to increase, but more specifically, the actual JGB, the orange line, has started to move back very quickly towards that fair value target. And the fair value target, the broken orange line, is at about 2 percentage points. So you can see that from a starting point in early 24 of almost half a percent, 50 basis points, or maybe a tad more, let's say 70 basis points, what you're seeing is a very significant increase in yields in Japan. And it looks as if from this chart, they may have another 50 basis points to go. And that's really what what we've been witnessing in the very long bond, the 40-year bond in Japan, which is yields are moving up with some alacrity now. And I think what people are realizing is that all these governments have got a fiscal situation which looks parlous, and it's getting worse because of demographics. To evidence that, you've got a third of the Japanese population which is now over 65. And that aging population is going to keep going. For example, I came across a wonderful statistic the other day, which said that a woman born in Japan in 2007 now has a life expectancy of a whopping 103 years. I mean, that is just unbelievable. So Japan's demographic problem and the burden of old age and welfare payments is going to keep going, and they're going to have to keep issuing debt or somehow monetizing this debt to afford things. And that's really an issue. Now, this is the story in Japan, but, we're looking at a similar case globally. And actually, if you look at the US, this is a chart which is intriguing, which really shows the mess that is also going on in the US bond market. The orange line here is the 10-year Treasury yield again, rather like the previous chart. But what I've put on this chart is a different calculation, which is looking at what is called a bootstrapped 10-year bond that I've calculated from the mortgage market, the mortgage-backed security market. Now, that market is government-backed. It's effectively a risk-free security. It does have different duration and convexity characteristics from a conventional 10-year bond, but mathematically, through the wonders of bond science or bond math, you can actually convert it back. So what I've done is I've reconverted or reconfigured those mortgage-backed securities back to equivalent convexity and duration characteristics to align them with the 10-year Treasury note. And therefore, you can see what a fair value should be on the Treasury note. And what that shows is that typically over the long term, with a couple of exceptions, the two yields line up exactly. But you'll see in 2020, actual yields fell below the bootstrap version. And then again, pretty much since 2003, they've also fallen below. Now, what is the characteristic or feature that causes that? The fact is that what has caused that in both occasions is very, very heavy Treasury bill issuance. First of all, through the COVID crisis. So the way to fund the government quickly during an emergency is to issue bills, and that's what they did. The banking system buys those with some alacrity. And what Janet Yellen also managed to hit on was that was a wonderful way of funding the government in the last 2 or 3 years through the Biden years. And broadly speaking, what she's done is to skew the issuance of US debt. What she did do was to skew the issuance of US debt towards bills and short-dated coupons. And as a result of that, she's pulled the actual yield down below its fair value. And again, if you look at the maths here, what it's saying is that US Treasury yields are about 50 basis points or so below their fair value. So what this is really telling us is that the yield base of global markets is going up. And that is clearly a worry. Now, let me just keep going. One of the things that does, and this is maybe getting a little bit stuck in the weeds here, but if you think that liquidity is very crudely equal to the amount of assets available divided by their duration, and you can drill down and say that, or quote that statistic again for the treasury market. So in other words, if you've got a situation where the government is switching from from note and bond finance to bill finance, then what you get is a situation whereby liquidity of the outstanding stock increases. And it's kind of equivalent to a liquidity injection by the Fed. Now, what I'm showing on this chart is something that we've been talking about before, which is called not QE and not yield curve control. Now, what you could broadly say is that the first of those, not QE, is the disguised QE that the Federal Reserve is basically undertaking through subtle means like running down the Treasury General account or running down the reverse repo program or whatever. That's actually injections beyond its stated policy, its current stated policy of QT, quantitative tightening, running bonds off the balance sheet. So they're actually using a backdoor method. And that is shown by the orange area. So you can see that that has been positive, but it's slated to sort of turn down sharply in the forecast period. There may be a little bit of a surge in the next few weeks, but it comes down. And then if you look at the red area, that's what the Treasury is doing through what we, tongue-in-cheek call not yield curve control. Think of this as Treasury QE, another way of doing it. And what is actually happening is that the twist in the structure of duration, available duration in the market, the switch from notes and bonds outstanding to more bills is actually equivalent to a liquidity injection, because the long-term institutions can't get the sort of duration that they want in the system, and therefore you're really thinking about a general liquidity boost. And that maybe is what the Treasury is currently planning, or that's the outcome. So all eyes have been on the Fed, and the concern is that the Federal Reserve is acting tough guy, but actually behind the scenes, what you're getting is the Treasury is actually loosening the purse strings through this means. And why is it that they do that? Why do they fund through bills? Because it's easy. The appetite for bills is unending. And it's largely because the banks, who are receiving a lot of bank deposits because of the very generous fiscal policy that's going on in America, they're building up their bank deposits on the liability side of their balance sheet, but they need assets to offset that to duration match. And what duration matches a bank deposit is a short-term Treasury bill or short-term Treasury note. And that's exactly what they're buying. So the appetite for bonds has gone up hugely. If you look at the increase, for example, in US money supply over the last 12 months, something like 1.3 trillion of increase has been supported by about a 400 billion increase in purchases of Treasury securities by the banks. So the banks are monetizing the deficit. And this is the worrying aspect. But this monetization is basically causing liquidity to expand. And that's why I think you've got this generous environment in the markets right now. And that's what we need to, figure. For example, let me just evidence that in an earlier chart. That's shown here, where we're looking at the SOFR spread versus Fed funds. And this is really a measure of the tightness in money markets. When that spread is elevated above the tram lines, you start to get tensions in the money markets. And you can see we've had an awful lot over the last 6 months. But look at the latest readings, and that is telling you that something else is going on. And maybe that explains why Bitcoin is testing all-time highs, because there's lots of liquidity sort of going through the system. So let me just stop sharing.
Yeah, great. It's always, I think everyone always loves your charts, and it's amazing to see them see what you're saying, sort of in a visual perspective. But I guess China is, as you said, they're going through a different avenue. So is that actual yield curve control, or what's happening in China? Because it seems like
China's
yeah.
a very different situation, and China needs a script by itself. The fact is that everybody is written off China, and they're saying China is mired in debt deflation, the banking system is bust, the financial system's going to fall apart, et cetera, et cetera. This is just sort of the narrative that we've currently got, which is very anti-China. I think the reality is that, as I've long said, the Chinese financial system is actually quite straightforward. What they need to do beyond anything else is to devalue debt, and they need to inject a lot of liquidity into the Chinese money markets. And that's really in the gift of the People's Bank. And it's a decision the People's Bank will have to make. And what I'm arguing is they're now making it. For a long time, they did not, because they wanted to hold the yuan stable against the US dollar. But actually now they seem to be more flexible on the currency. And in particular, what they seem to be doing is letting the currency devalue aggressively against the price of gold. Now, that's, a story in itself, but I think it's a very big story, because what's happening is that China is reflating. And I think that reflation is starting to come through in terms of world activity. And what you're seeing is a very significant rebound going on in the world economy. Now, let me just evidence that. So I'm going to go back to these slides. So this is the picture for China. This is showing the People's Bank's net liquidity injections into the system as a rolling 6-month sum measured in terms of billions of yuan. And what you can see is that there's been a steady build-up, but let's contrast the picture now in, let's say, the first half of 2025 with what you saw through most of 2024. So through most of 2024, their liquidity injections were going down, and then they've basically turned. Bear in mind, this is a rolling 6 months, so it's really giving you the trend. And that data is seasonally adjusted, so it takes out things like the Lunar New Year and the great seasonality in Chinese money markets. But it's very clear that they're treading a new policy path. And what I think they're doing is they're trying to devalue the yuan. Now, this chart is illustrating the yuan gold price and the yuan US dollar cross. Now, the reason for showing the two together is that what I'm trying to do is to contrast the fortunes of the yuan dollar with the yuan gold price. The yuan dollar in black is shown on the right-hand scale, and that's been, generally speaking, quite stable, although you can see that, it has generally drifted weaker over time. The Chinese have been trying to hold it down into a range of, let's say, around, for argument's sake, say 7.1, 7.3 against the US dollar, and it's basically beginning to weaken, more through that level. Now, I don't think the yen dollar is really should be the focus, but everyone's looking at that. There's no way that the Chinese are uncompetitive against the US dollar, and it wouldn't do them very much good, I don't think, to actually devalue against the US unit. What they really want to do is to get out of their debt problem. And the way that they get out of their debt problem is to devalue the paper yuan against real assets. And if you hold that thought, reconsider gold as a real asset, which it is. And therefore, what they need to do principally is to devalue the paper yuan against the gold price, if gold is the proxy for all real assets. And you can see what's happened here since the beginning of 2022 is that the yuan gold price, which is now just about 23,000 or just over 23,000 yuan per ounce, has more than doubled over that time period. Now, we set out about 18 months ago a policy where we said, if China is to get its debt back in order, in other words, it needs to get its debt to liquidity ratio, which is the key metric, not the debt to GDP ratio, which is a fake narrative that economists talk about. What you need to do is to get debt and liquidity back in line, because debt needs to be rolled over and refinanced, and you need liquidity for that. China's debt liquidity ratio, I should say, was about 30% above normal levels going into this crisis. That's why they had the crisis. And what they need to do is to expand the liquidity base by about 30%, which basically means adding huge amounts of liquidity to the system. In terms of what the yuan gold price needed to do, we figured that would mean at least a 26,000 per ounce yuan gold price, and we're well on that target. If you cross-reference that, looking at what that would mean in dollar terms, it would mean a dollar gold price of over $2,600 per ounce of gold, and I think we're on track for that. The gold price, as I say, that's the minimum target. Gold has got to go up further. But what you're seeing very clearly in the case of China is monetary inflation is being created. And monetary inflation is not just a Chinese phenomenon, it's becoming a global phenomenon, because more and more policymakers worldwide will have to address this problem, particularly as yields are rising in their bond markets, of how to fund their governments. And the only way they can do that is to monetize fiscal deficits, which basically means printing money. And this is what we've going on. This is what's going on right now. The important point to stress is that monetary inflation is not necessarily high street inflation, but it may well become that. Monetary inflation is devaluing your paper money against real assets, or devaluing, let's say, your currency in general, letting your currency fall, particularly against gold. High street inflation is a cocktail of both monetary inflation and cost inflation stroke deflation, and the high street can vary quite a lot, particularly if you get things like tariffs involved, or you get things like productivity changes, you get technological breakthroughs or whatever it may be, or you get cheap Chinese goods being dumped. All those factors affect the high street. They don't necessarily, they clearly don't affect monetary inflation, but the two together, monetary inflation and costs, tend to affect or influence the high street or CPI basket. And therefore, what we've got to do is to protect our assets against monetary inflation. Assets are far more vulnerable to monetary inflation than they are to high street inflation. But it means that you've got to buy dedicated monetary inflation hedges, which is what we've been saying for much of the last 2 or 3 years. You've got to buy Bitcoin, you've got to buy gold. These are the things which are necessary in portfolios, both now and in the long term. Governments, the only solution they've got is to basically monetize. And this is what we're seeing more and more, whether it's issuing short-term bills, short-dated coupon debt, whether it's Federal Reserve QE, whether it's disguised Treasury QE, whether it's China injecting lots of liquidity. It's happening worldwide. And this is what we've got to be conscious of. You do not want bonds. And the sort of last comment I make on this section is to say, look, this is about monetary inflation. This is not about financial repression. Financial repression is, I think, a sort of, again, a fake narrative. It may well be that governments are trying to do elements of this, but if you go down the road of financial repression, you get lured into doing things like buying. You might buy value stocks, or you might not buy bonds. I mean, not buying bonds is sensible, but what you really want, and what the monetary inflation dialogue says, is you've got to buy monetary inflation hedges. That's really the key thing. You've got to buy Bitcoin and you've got to buy gold over the medium term. So let me stop out this part.
Yeah, well, one thing I would say is it does seem that this is not just a one gold trend. This is an every currency gold trend, because it looks
absolutely. I mean,
quite
as I'm
similar to
saying,
the US.
monetary inflation is happening everywhere. But the thing is that, what we're seeing, where it's obvious, is in China, because I think they're explicitly doing this. They're explicitly trying to devalue the yuan against gold. And by doing that, they're getting themselves out of their debt problems. Now, the world is too, generally, by monetizing, but you register that because paper money is devaluing against real assets like gold. And it's very difficult to find a real asset that you can sensibly value things against. But gold is a pretty convenient benchmark, which is why it's always been used.
Yeah, and I guess and you were saying the reasons that their yields are lower than, I guess, the rest of the world is because their economy is really struggling. First, the rest of the world at least seem like they're a bit stronger.
Exactly. Okay. And they're basically got interest rates low because they're undertaking this process of trying to expand liquidity in the economy. And they're doing it. I mean, as we speak through May, there's even more liquidity going into the system. So the Chinese are definitively changing their policy.
Yeah, really interesting here. So as you said, it sounds like you think next few months could be quite positive for risk on assets, but then after that, there's the risk that well, depending on what the liquidity.
I think they're positive. I think it's a positive environment. Accepting the fact that the bond markets are selling off, and what one knows is that that can by itself cause a problem. Because if you start to get yields punching up in the US through 5% or so, it's not impossible for sentiment with regard to the economy to deteriorate quite badly. And that might cause Wall Street to come off. Doesn't necessarily alter the trends in Bitcoin or gold, I'd say, but it may well adversely affect stocks. So, after this rally, and we've had a fierce rally from the lows, maybe it's time to just step back a little bit and wait for a pullback and then maybe go back in again. But I think what I'd really like to see is a lot more clarity on what the Fed is doing. And as I've sort of floated this idea that maybe the Federal Reserve is sounding tough here and unrelenting on its balance sheet shrinkage because it knows or acknowledges that the Treasury is basically, with the other hand, injecting a lot of liquidity back into the system.
Yeah, and I guess the issue is, if they pull away from the not QE, or if they reduce interest rates, I imagine that would be, bond yields will go higher. That seems to be the current trend that we've seen in the last 2 rate cuts. So that's a bigger issue.
I think that's right. I mean, but because I think what is happening is the bond market, the bond vigilantes are getting suspicious about what's going on here, and the treasuries or the policymakers generally are saying being forced into a corner, and the only thing that they can do, kicking and screaming, is to try and get interest rates down to lower the cost of front end debt, or actually do a lot more debt issuance at the front end of the market, and do a lot of issuance at the front end of the market. And that kind of is what's going on. But that's monetary inflation. And, what's happened is the baton of liquidity creation has been passed from the central bank to the banking system. And the banking system is doing this because they're buying up the treasuries, that the treasury is issuing, the short-dated debt, because that's what they like. But as they buy it up, their balance sheet expands. And that's basically a liquidity and a money supply expansion. And the thing, the crazy thing is here that if you go back to the 1970s, which I can just dimly remember, even me dimly remember, but what you had in the 1970s, there was a similar episode where bank balance sheets started to expand, and that was the source of monetary inflation, and it didn't end well. This is the warning. But what you wanted through that period, the lesson was that you wanted monetary inflation hedges. Gold did well.
Yeah, and I guess the issue that they have now is that everyone is over-levered. Companies, countries, people. So I guess that's the risk that they have as well, of massively increasing inflation without. I guess they'd have to bring in yield curve control. Then they couldn't do it with high interest rates.
Well, I think it would be very difficult, but I think what this needs generally is some sort of reset. And I don't know what that reset is or what it looks like, but what you're looking at is either governments go down the route of raising taxation a lot more from wealthy. In other words, warning here that you're going to get wealth taxes coming. Just look at the evidence lately in Australia, where they're deciding to tax unrealized gains in pension funds. I mean, that is unbelievable, but it's happening. Believe me. I think it's happening from July. But this is, a surreptitious wealth tax, or maybe actually it's not. It's actually an explicit wealth tax. And what you're going to get is more and more governments looking at ways of raising taxation, and taxing the wealthy, or these wealth gains are inevitable. That's what's going to happen. The other course they can do is to actually pare back welfare commitments. And that's something that I think is going to have to be seriously thought about, because it's just completely unaffordable. If you go back to my statistic on Japanese, the longevity of Japanese, in the West, we don't enjoy the same lifespans, but clearly in terms of relative terms, our lifespans are going to increase relative to now.
Yeah, and I guess the more we see the wealth taxes, and I guess that's a challenge, there could be further financial repressions to try and reduce.
Well, there's only four. I hesitate with the financial repression. I think it's clearly happening, but I think it's the wrong narrative for investment, because what financial repression doesn't lead you into things like gold or Bitcoin. What it does is it leads you away from bonds, which maybe is a correct thing. But what I'm trying to stress here is that financial repression is all about income, protecting income. And what I'm saying, you've got to protect wealth. That's the bigger question here.
Yeah, no, great. So Michael, thanks so much for sort of covered on so many different aspects, and really enjoyed it again. But my last question is, what is one message you want people to take away from our conversation?
Well, I think you've got to watch liquidity. Liquidity is all important, and that is what's driving the system. And these cycles in liquidity, they're difficult to gauge. You need to drill into the data. We do that at CrossBorder Capital. I mean, that's our expertise, and we're trying to sort of deliver to our clients the clearest message that we can about what the direction of global liquidity is. And you can get that either from subscribing to our institutional research at www.crossbordercapital.com, or look at the Capital Wars Substack, which is where we give let's say a tighter version of that.
Yeah, great. I'll put that in the description below. But Michael, thanks again for your time.
Thanks, Anthony. Enjoyed it. Thank you.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.